Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Reports and Banking on Profits newsletter, coming to you from just what is a glorious afternoon down here in Central Florida. Nice and hot and sunny. No rain on the horizon so far, although it is Central Florida. That could change any minute now. This was an up week for the market. Nice surprise after the last 5 or 6 weeks where the market struggled a bit. We're up about 1.3% in the S&P 500, while the all-world URTH ETF, based on the MSCI indexes, was up about 1.25% as things stabilized just a little bit out there. And the index of small bank stocks that we track, the QABA Community Bank Index, was up about 0.15% as our bunny rabbits go back to sleep after earnings season comes to a close. We did get some scares on Friday. Got a little messy. Everybody's eyes, of course, were on the Ukraine, trying to determine if that was a military convoy coming across or was it actual aid supplies, and how much aid did the Ukraine really want to take from Russia, and did they want even a Russian presence in the country? Now, as it turns out, they have done a preliminary sort of inspection, and the aid convoy is actually aid supplies. However, the Ukrainian government also said they did mostly destroy an armored convoy that crossed from Russia into the disputed territory during the week last week. So I guess it's a little bit of aid, a little bit of armor. In fact, one Ukrainian official said, "Isn't this great? They're sending us armor and rocket launchers by night, and then in the light of day, they're sending aid supplies." So, still a very difficult position over there. We don't know what's going to happen. World's eyes have very much turned to it after ignoring it for an extended period of time. We're tossing sanctions back and forth, and Mr. Putin does not really seem to care too much about the sanctions or world opinion. After not caring about the Ukraine for several months, everybody's focused on it. We don't know what will happen, but we'll see what develops over the course of the next week and if it moves the market in one direction or another. Things also continue to escalate in Iraq. We have heavy fighting around that dam in the Mosul area, and U.S. airstrikes have picked up quite a bit from what the news is reporting. This is a potentially dangerous situation, guys. This is an enormous dam that needs continuous maintenance or it's going to break. And God forbid a bomb hits this thing, because the experts are saying should that happen, it's going to flood all the way down to Baghdad, and a lot of the surrounding towns will just be pretty much eliminated. It could be a humanitarian disaster. So we're keeping an eye on that situation too and see how much further things escalate in Iraq. Now, we were up on the week, and it's mostly attributed to the fact that we had bad news on just about every economic front that you can imagine during the week. The Japanese government had hoped that the April sales tax increase wouldn't hurt. It did. The Japanese economy declined by 6.8%, they reported last week, which is a huge number. It's a little bit better than the average economist expected. Shocking that those highly accurate fellows are wrong yet again. They were looking for a 7.1% decline. But 6.8% is a very serious decline. And it's starting to talk, some traders are saying, hey, the Japanese government's going to have to reevaluate what they're doing here. They may not, in fact, be able to wait until next year to add more stimulus. We'll see what the next couple of series of numbers out of Japan look like. But things are slowing down over there, and that could be a huge problem, creating not too many new bargains in the stock market, unfortunately for us. But that could change in a big hurry. We also saw Germany slow down. And growth decline. And that's huge because Germany's been pretty much carrying all of Europe on its back for the past couple of years. Now, in the reports, of course, France and Italy just continue to be absolute disasters. They're showing numbers that keep them barely out of recession, and I think they're padding those a little bit because conditions, as far as unemployment, jobs growth, and just everything about the economy in those two countries is horrific right now, and it's providing a huge drag on the Eurozone. Here in the United States, we had the worst retail sales number in about 6 months. Walmart's lowering their guidance and projection again. People are not shopping. There's not enough high paying job creation going on. People being very, very careful with the dollar bills they have in their back pocket these days, and they're very reluctant to spend them. So we're 70% consumer driven economy. If this doesn't pick up, it's going to be a real drag on that hope for huge boom in GDP in the second half of the year. Likewise, we're still not seeing any good numbers out of the housing market. Everything that you're looking at is showing numbers substantially lower than last year. And some folks, including myself, are starting to think that housing may not be the boom that drives the economy forward. It may actually start to be a drag on the U.S. economy. Now, all of that means, of course, that from a trader's perspective, all the central banks around the world are going to have to pause, consider adding some stimulus. They're certainly not going to be able to tighten anytime soon. And the U.S. is going to have to keep interest rates low for an extended period of time. So, the crack pipe is still out there in the form of low interest rates, and it's traders are very delighted about that, and they bid the market up quite a bit this week. You got a real battle going between the disconnect between Main Street and Wall Street. Wall Street's doing fine. It's going up. Bonuses are getting paid out. Stocks are higher. But on Main Street, nah, not so much. Very low paying part time job growth, better than it was, but a long way from good. You've got that to look at. And then you also have the fact that there is a lot of geopolitical hotspots right now. But the real focus is on those central banks and what they're going to do about interest rates. One of the scariest lines I've read in some time came from a FactSet report that I got by email this week. And they kind of went over what's going on in the market. And the one key line that jumped out at me is that this week's economic activity should put the market's focus back on policy dependency. Now, when the stock market is dependent on government policy, we have a bit of a problem. We're not talking about corporate events or earnings or all the good things that are happening. We're talking about stocks going higher base or lower based on government actions. Now, given the government's track record with just about everything else that they've tried to manage over the decades, that should worry you a little bit. It does me. I'm in the camp with John Druckenmiller very much. I think this is bad policy at this point in time. It has not worked. I don't know how it's going to end, but if it ends well, it's going to be a shock to me, quite frankly. So we'll see how all this develops. Everybody's eyes are on low interest rates. We'll see if anything happens geopolitically to change that during the week. Two big things this week. First, it was 13F week. That's always a fun time for me. I started covering 13Fs back when you had to write to the SEC and they would send them to you. And we actually subscribed to a service that did that for us and compiled everything and brought us the lists of who was buying what. And then you could get your Quotron and your S&P stock guide and you could try to figure out which one of these were still bargains. Now, it's electronic filing. The news of who's buying what hits the tape within seconds of the file showing up at the SEC. And it's covered everywhere by everybody. But the funny thing is everybody covers the same 10, 12, 15 guys. Warren Buffett, John Paulson, Bill Ackman, Seth Klarman. I read all these filings. They have valuable information, but I don't really comment on them in any of my columns around the web anymore because I'm just not really adding a lot of value. And generally speaking, the ideas get bid up so fast by traders that there's not really a lot of follow-on activity worth doing. In fact, I talked to a trader friend of mine last week who's having a lot of success fading the short-term pop in 13F names. People were rushing into buying them because, Warren was buying them or Bill Ackman was buying them, so they just piled right into these things. They popped up a couple points and immediately got slammed right back down. Not a game I want to play. However, we have been spending time, a lot of time, and I've still got a few more to do this weekend. They'll probably get done tomorrow, to be honest. It's a really nice day out there. From some of the smaller funds and firms that I've followed that do provide a lot of value added as far as their buying and selling activities. I'm talking about firms like the Bank Stock Activists, PL Capital, my friends at FJ Capital up there in Arlington, Virginia, Joe Stillwell, Lawrence Seidemann, all those guys. Michael Price has been a great place to steal ideas since he was at the head of mutual series funds many, many years ago, back in the dark ages of paper filings. Nobody pays much attention to Mr. Price anymore, but he's still running a fund, MFP Investments, of his own money and I guess a few friends, and he's still buying great stocks and a real big participant in the trade of the decade in small banks. I've stolen some great ideas from him over the years, and hopefully I'll steal a couple more this quarter. We still got a lot of cash to invest, so I wouldn't mind finding some good stuff. And then we're also, Arbiter Partners is one that we've started to follow since reading about him in a Barron's interview and then meeting him in New York. Outstanding gentleman. Paul Isaacs runs that fund. He has the unique space in value investing history in that his father worked for Max Hine, one of the original value investors and arbitrage guys, but his uncle was Walter Schloss, who of course is one of my basic gurus and mentors, I guess you would say, since I try to follow his approach to the markets very, very closely. Mr. Isaacs has had outstanding success over the last decade, and from 2001 through about 2012, he was racking up well over 21% a year while everybody else was going sideways. This is a smart guy that knows how to pick stocks. So we steal some ideas from him as well. And then, of course, EJF Capital Management, which is all the old guys from Friedman Billings, a firm I came to love to hate back in the 1990s when I had to compete against them trading small bank stocks and REITs in the Mid-Atlantic region because they took the market from our firm and just absolutely dominated the space. They're a fabulous source of ideas for real estate oriented investments, small bank stocks. They're very much in the trade of the decade along with the rest of us, and especially smaller REITs. I've stolen some great ideas from them in the past couple years. And again, I've got the filing here on the desk. Hopefully, we're going to get through it and steal a couple more ideas. The other big thing this week, it's numbers week. Not my favorite thing to do, but I sat down, did all the spreadsheets by hand once again because I'm just not very good at this whole data base and exporting and importing thing. So we did them by hand, and we got some great numbers. The deep value portfolio has just been kind of on autopilot this year. We are lagging the market. You would expect that with a 65% cash position. Timing is everything, and ours was horrible when we started the letter. We started it back in 2010. Results would be a lot better at this point in time, but we've got some great stocks in there, and we expect to get more. Eventually, the market will pull back, and I'll get smart once again. But right now, the portfolio as a whole is trading at about 79% of tangible book value. It's got a credit and fundamental score average of 9. Remember, it's got to be a minimum of 8, which is pretty strict to make it into the portfolio. The average is a little bit better than that. And your average yield's about 1.79% right now. Now, when you break it down and you look at just at those stocks that I have rated buy this week, you're down to about 68% of book value. Credit and fundamental score stays the same at about 9. The average yield comes up to about 3.25% because there's a couple high yielding REITs on the list. International deep value comes in at about 66% of tangible book value for the list as a whole because we have some really cheap stocks in that portfolio, and the average yield's about 2.7%. Now, banking on profits breaks down like this, a little bit differently because we keep score differently. It's about 94% of tangible book value for the portfolio as a whole. That's pretty cheap. It's lower, certainly less than the even the small bank and thrift indexes kept by SNL. We've got an equity to assets of 12.9. Remember, I like 10 or higher, so we've got a pretty comfortable margin of safety right there. These banks have plenty of capital, which means that capital can eventually find its way back to you in the form of a dividend or possibly a share buyback. We have some of these, particularly the recent thrift conversions, where you've got 17, 18, 19% equity to assets value. So that capital is going to find its way back to us somehow, I'm sure. And on average, we got about 1.55% non-performing assets as a percent of total assets. So these are sound, well-financed, cheap banks. But when you break this down to just the stocks that I have this week as buys, that gets a lot more fun. You're down to 79% of tangible book value. The equity to assets actually improves to 13.6. So the buy list stocks are not only cheaper, they're a little bit healthier than the list as a whole. And then you've got a 1.69% non-performing assets. So we have a couple special situations in there that notch that number up just a little bit higher. If you're not in the trade of the decade, I don't know why. I don't care if you're making all of your money trading in nanoseconds. Some percentage of your capital should find its way into these small community bank stocks, unless the idea of making 5 to 10 times your money over the next 5 to 10 years is somehow offensive to you. If that's the case, then I can't help you. But if you would like to see your money multiply by that type of factor, I believe community banks is the place to do it, and we've got a pretty good portfolio of them over at Banking on Profits. So I hope you'll join us over there. That's it for my sales pitch. I'm done. Okay, moving on to more interesting stuff. In baseball, the Orioles are still in first place, but we're fighting real hard right now to avoid being swept by the Cleveland Indians. It's close. We're losing in the 6th as I'm filming this. Bats have just gone absolutely dead. We're not hitting the ball. We got a lot of talent in that lineup. There's no excuse for that. Pitching has shockingly held up okay, except for Mr. Jimenez, who decided to give up some long balls that really hurt us yesterday. Fortunately for us, Toronto is also on a bit of a losing streak, and they are losing right now to the Chicago White Sox, so not gaining any ground on us. We go to Chicago next, and we play the White Sox, and then in what is a head scratcher on the part of the schedulers, we're going to play a series against the Cubs. Going to be a lot of fun to watch. Wrigley Field's a really cool place, and hopefully some of my Chicago friends will get out there and take in the games, call me up and let me know how it's going and how cold the beer is. All right, your hot teams right now. Kansas City Royals. I called this one, guys, back at the first of the year. They're giving Detroit everything they want. They are, in fact, in first place. They've won 8 of their last 10 games, and the team is catching fire at exactly the right time. Not going to be surprised to see them win that division over Detroit this year. Washington Nationals are also 8-2, very hot, starting to swing the bat well. And of course, they have a fantastic pitching staff, and it looks like they may be able to hold Atlanta off this year and win that division, as we've expected for the last couple of years, actually. And the Seattle Mariners out there in the West are also hot. Unfortunately for them, they have the Angels and the Oakland A's in front of them with a pretty good lead, and I don't think they can catch either one of them. There's too much talent on those two ball clubs, especially Oakland's pitching staff. That's just ridiculous. Now, fortunately for us, Milwaukee Brewers and Hank the Wonder Dog still running strong, 7-3 in their last 10. They just had a Hank beach blanket giveaway, and if any of my friends in the Milwaukee area got their hands on one of those, I would trade you a Womack t-shirt straight up for it. I'd love to have one of those things. It's the feel-good story of the year in baseball. Really hoping Milwaukee makes it into the World Series and brings Hank along. Now, unfortunately, he'll have to lose in Baltimore, but that'll be okay. It'll still be a great story to be the National League champions with Hank, the rescue dog they brought home from spring training. Just a fantastic story. Hank even inspired them to be one of the first teams to beat Clayton Kershaw in quite a few games last night. So anyway, on the book front, some pretty cool stuff going on. Tobias Carlyle's Deep Value is coming out next week. This is the print edition that's coming out. I spoke with him earlier this week, and he told me that the electronic or Kindle version will be out relatively early in September. So it depends how you want to buy it. Randy Wayne White has a new book coming out. This is one of my favorite recreational reading authors. Now, this is the third one, I believe, in his new Hannah Storm series, which is a spinoff of the Doc Ford series, and I'm sure Doc will show up in the series. But if you like recreational reading, just great stories based in Florida, quirky characters, a little bit of espionage, a little bit of mystery, and there's some fantastic characters. This is one of my favorite series of books all time. Do yourself a favor, go back to the first book in the Doc Ford series, and then binge read them forward. I know everybody likes to binge watch TV. Let's do some binge reading over the rest of the summer. This is a great series of books. You will thank me for sending you to read, doing a little binge reading of the Doc Ford series. But anyway, the Hannah Smith book will be out Tuesday. I will, of course, be buying it. It looks great. Anyway, don't forget that Business Adventures by John Brooks was re-released last week. That was an out-of-print book that both Bill Gates and Warren Buffett have said is one of the best business books they've ever read. If Warren Buffett and Bill Gates both say a book is great and you're in business and don't read it, you're not thinking clearly, because those are clearly two of the greatest businessmen of the last 100 years or so. So you probably want to pick that one up now that it's re-released. And then a fascinating book that I actually can't wait to read. I love the lore of Las Vegas and of gambling and of poker in particular. And there's a new book out called Blood Aces, The Wild Ride of Benny Binion, the Texas gambler who basically helped remake Vegas and invented the World Series of Poker. And he had a really simple formula for success, according to the book jacket. You run a good business, network with the big guys, own the cops, and kill your enemies. Sound philosophy. We can't wait to read the book, because I'm sure it's going to be a fantastic story and adventure of the early days of Vegas and gambling in the World Series of Poker. So I will be reading that. If you're into poker and gambling, as I have been from time to time, I'm sure you'll enjoy it too. Now, we got a big week coming up as far as numbers and reports. Remember how we've talked about housing and the fact that Wall Street and the economists have really said, hey, the housing's going to push us forward. It's going to be the growth driver, and it hasn't happened. We got a lot of housing numbers out this week. We have the Home Builders Survey early in the week. We have housing starts. That's a huge number. And then the biggest number of all is going to be existing home sales. Ordinary times, these numbers can be just a bit of a blip on the reporting radar, and nobody really cares. But with the focus on housing is its contribution to the economic growth, I think the market's going to be watching these really close, and these could be market moving numbers. So let's keep an eye on that. We have consumer prices out, I believe, on Tuesday. We'll see how that goes. Then, of course, we get the FOMC minutes, and it's just I'm always amazed by guys that will spend all day. I know a guy who'll spend all night. He'll be up analyzing the FOMC minutes, and he'll be looking at where the periods and the commas are and what they said about this and who voted on this. Here's what the FOMC minutes are going to say. Things are a little bit better. We see some encouraging signs, but we see some stuff we don't like, so we're going to have to keep interest rates low for a really long period of time, although we are going to continue to cut bond purchases. So there's your Fed minutes in a nutshell. Saved you about 5 or 6 hours of reading. I'll be shocked if the tone of the report deviates at all from what I just said. Then we have the Jackson Hole Fed meeting. This is where all the Fed governors and everybody go out to Jackson Hole, Wyoming, I guess, grill some steaks, have some drinks, sit around, talk about Fed policy and what direction they should go and what's going on in the world. A big confab every year. Janet Yellen will speak on Friday, and you better believe that that has the potential to move the markets all over the place. So, should be an interesting week. Lots of stuff going on. Maybe we'll see some. It's been 2 weeks without a bank takeover, so I'm feeling kind of lonely. Hopefully, we get another one of those this week. We're 5 for 5. We've got 5 takeovers for better than 50% gain so far this year. So, pretty excited about that and hoping to see some more. Anyway, that's everything from down here in Central Florida. I'm going to go out here and enjoy the sunshine for a little while, and we will talk to you guys next week. Thanks for listening.